Hey there, Rockwall. So, do you ever get that feeling that the economy might be sending some mixed messages? Like one minute it's saying, we're fine, everything's fine. And then the next they're quietly texting, hey, maybe start saving those leftovers. Just me? Well, let me tell you why this is the read I'm getting on the market. I'll start with jobs, because if the job market is strong, people feel bold. They buy houses, upgrade cars, they spring for guacamole. But right now, the job market, it's looking a little tired. Job growth is stalling out, meaning we're not adding as many new positions as before. Then there's inflation, everyone's favorite party guest. It's still a little too high, sitting above the Fed's 2% target. The core inflation rate, well, it's currently at 3.1% year over year. Not runaway inflation, but enough to make everyday things feel, expensive. And when you pair slow job growth with the high prices we're seeing with everything right now, well, it's no surprise that Americans are frustrated with the economy. And here's the chain reaction. When inflation stays high and job growth cools, people hold off on big purchases, like homes. So if you've noticed buyers feeling hesitant lately or seen it reported in the headlines, it's not just you. The data backs it up. All of this now has about 2/3 of Americans, or 66%, believing a recession is coming, and 74% of Americans say world news and current events are influencing their financial decisions. That fear has led to what I call decision paralysis 2025. It was also decision paralysis 2024, but here we are. And it's where people keep saying, I'll just wait and see what happens. They're waiting on rates, waiting on clarity, waiting for someone else to jump into the murky water first to let the rest of us know it's okay to get in. Then there's this other factor, the one thing that everyone is currently obsessed with, interest rates. Because let's face it, in real estate, interest rates are kind of like the weather. Everyone complains about them, no one can control them, and when they finally start to cool off, well, suddenly everyone wants to go outside again. The single biggest factor driving affordability and market activity right now is mortgage rates. For buyers, the number one wish on their list has been simple: lower rates. That's the golden ticket. Even a small drop in rates can save buyers hundreds of dollars a month, and that's the kind of change that gets people off the sidelines. So as rates improve, even modestly, affordability opens up and the market starts to stir again. And that's exactly what forecasters expect will happen. Kind of a reawakening in 2026 as lower rates slowly bring more people back into the market. The good news? Mortgage rates have already eased off their highs from earlier this year. The average 30-year fixed-rate mortgage recently dropped to about 6.2%, and the monthly average for September 2025 was 6.35%, and that was actually the lowest level we saw this entire year. For comparison, back on January 14th, rates hit 7.05%, their peak for the year. So we're down almost a full percentage point from that high. It's not a miracle, but in mortgage math, it's meaningful. The overall trend is we're gently declining, but let's not get ahead of ourselves. When rates come down, they take the stairs, not the escalator. In other words, it's going to be a slow, slightly awkward descent, the kind where you keep checking if you've reached the next floor yet. Most forecasters expect modest improvement over the next year. Some say we could see rates in the low sixes where we are now, maybe even flirt with the high fives. By the end of 2026, top forecasters, including Fannie Mae, think we'll be hovering around 5.9%. So the direction is good, it's just not fast. Now what happens as rates ease? Well, a few good things: increased affordability. Even small rate drops can shave off hundreds of dollars from monthly payments. That's real money that makes homeownership more accessible again. Stronger buyer demand. We already saw this in September. When rates eased a little bit, purchase applications did go up. Buyers started poking their heads out again. Total home sales are projected to rise from 4.8 million in 2025 to 5.2 million in 2026. Moderate price growth. As demand improves, home prices aren't expected to tumble. Instead, they should actually rise at a more steady, sustainable pace, keeping the market healthy and balanced. But what does all of this mean for buyers right now? Well, it's a little complicated, isn't it always? Because right now, buyers are caught in the middle of two big forces: high financing costs and limited inventory at a price buyers either can or are willing to pay. And it's making the home search feel a lot like Goldilocks trying to find a bowl of porridge that's not too hot, not too cold, but somehow still affordable. And even though rates have cooled from their January highs near 7%, they are still a challenge. And also factor in higher insurance costs and property taxes, and you've got a recipe that's pricing out a big portion of would-be buyers. The math that used to get you a 3-bedroom in your favorite neighborhood might now only get you a 2-bedroom in a cozy backyard. The shift in affordability has been a real wake-up call, especially for buyers who were expecting 2019 prices to somehow make a comeback. And you might have heard that inventory is finally rising, and that is true. Nationwide, we've crossed 1 million active listings, a level we have not seen since the winter of 2019. But here's the twist. Even with more homes on the market, experts still expect national price appreciation to continue through 2029. So that idea of waiting for prices to drop, well, it's probably not the winning strategy this time around. But with some challenges, we can also find some opportunities, like less competition. With higher costs and uncertainty keeping some buyers on the sidelines, the ones who are shopping right now have more breathing room. In September of 2025, only 25.3% of U.S. homes sold for more than their final list price. That's the lowest September level in 6 years. And the typical home now sits on the market for 50 days before going under contract. That's the slowest September pace since 2016. So that translates to buyers finally having time to think, compare, and even negotiate. And opportunity number 2, you get more negotiating power. With more listings and slower movement, sellers are cutting prices more often, and they can't be too picky on pricing if they want showings. That means buyers now have leverage to ask for repairs, credits, or even rate buydowns. It's a sluggish market, but that sluggishness is your friend if you're buying. And a third opportunity is the new construction advantage. Let's not forget about those new construction homes. Builders are working hard to move their inventory, and their incentives are pretty juicy. They've got mortgage rate buydowns to cut monthly payments. They've got price reductions. Builders have dropped their prices about 13% from the peak of the market, and they're helping with closing costs and free upgrades. This window of opportunity with new builds is especially strong right now. So here's the playbook for buyers heading into late 2025 and 26. 1, act on the trend, not the volatility. Mortgage rates are trending downwards, slowly, yes, but steadily. But don't get caught up in the week-to-week swings, because while I know your goal is to time the bottom and lock in then, the problem with that strategy is you never actually know where the bottom of the market is until it has passed. And number 2, leverage your position. This market finally offers breathing room. You have more time, more inventory, more power to negotiate. So use it. Ask for that concession, that repair, that buy down. You might just get it. And again, explore new construction. Roughly 6 out of 10 new home communities are offering some kind of incentive right now. That's a big deal, especially if you can roll those savings into a lower monthly payment or upgraded finishes that would have cost more a year ago. All right, sellers, now it's time for us to talk about your side of the story. If you've been holding out for the days of list on Friday, sold by Sunday, I've got news. Those days have officially left the chat room. Today's market is less blink and it's gone and more grab a coffee. This might take a minute. It has fundamentally shifted. We've moved from a hyperspeed multi-offer frenzy into a slower, more strategic environment, one that rewards preparation, pricing discipline, and a good dose of patience. The market is no longer a quick turnaround or hyper-competitive. It's what economists politely call sluggish. High costs and economic uncertainty have buyers thinking twice before making big moves, and that's reshaping how sellers have to approach their listings. Pricing correctly from day one has never mattered more. The market is highly sensitive to cost, and the biggest trap right now is sellers trying to price their homes like it's still 2021. The reality? More inventory and slower buyer urgency mean that overpricing can quickly backfire. Sellers who start too high often end up making larger price cuts later, and that usually hurts more than just getting it right the first time. So price strategically, low enough to attract attention, but smart enough to spark competition. And remember, there is no way you can underprice a listing that's truly desirable. The market will bid it back up if it's worth it. And here's the other big thing. Buyers have higher standards now. When inventory was scarce, buyers would overlook so many flaws. That leaky faucet, the 90s light fixtures, that character carpet. Now with more homes to choose from, they're picky. Move-in ready homes are getting all the attention. So sellers who invest in presentation like decluttering, repairs, fresh paint, modern staging, well, they're seeing better results and faster offers. And here's the good news. This isn't a doom and gloom market, it's just different. And despite the slowdown, prices are expected to keep rising nationally over the next 5 years. So not a crash. Even the most cautious forecasts still predict around 5% appreciation in the coming years. So while short-term patience is required, long-term equity remains protected. This quieter stretch is setting the stage for what's next. As mortgage rates gradually ease, potentially dipping into the lower sixes, even high fives, buyer demand is projected to rise. Total home sales are forecasted to climb from that 4.8 million number that we project for this year to 5.2 million in 26, which means more activity, more offers, and a healthier market overall. So set your price for the current market, even if that means being the lowest in your area. If buyers see value, they'll compete for it. If they don't, well, then their silence, that's your answer. The people most likely to pay top dollar are the ones who are actively searching in the market right now. They know the market, they've seen what's available, and they'll act fast when something truly stands out. So the question is, does your home stand out? This is also the time to expect and accept negotiation. Buyers have leverage again. Expect requests for concessions, repairs, or price adjustments, and plan that flexibility. Also, this is not a market where you can leave anything to chance. Right now, visibility on your listing is everything. You're not just selling a home, you are vying for attention in a very crowded and very cautious marketplace. That means it's time to pull out all the stops. So we've got that competitive price from day one. Also, a model home level presentation. And I know that's tough, but buyers need to feel something when they walk through, and it's not the ickiness of a dirty house. Take professional photos, have a 3D tour, and a compelling video that makes people stop the scroll. Paid marketing, not just posting online. This means targeted social media ads, YouTube ads, and Google search campaigns that reach real buyers where they actually are. And here's a word of caution. I've talked to so many sellers who thought their agent was doing online marketing only to find out that just meant like a just listed post on Facebook. That's not marketing, it's wishful thinking. So ask your agent for specifics. You deserve to know exactly how your property is being promoted, because in this market, strategy and exposure win. Luck doesn't. Next, we'll zoom into what all this looks like right here for our local Rockwall County market. Because the national trends set the mood, but the local data, well, that's what tells the truth. And Rockwall County's market is at a bit of a crossroads. After a wild ride of supply shortages, bidding wars, and pandemic-era surges, we've landed somewhere entirely different. The market today feels balanced in some places, tipped towards buyers in others, but across the board, it is slower, more strategic, and a lot less chaotic. A few years ago, we had less than a month of inventory. Now we're at about 6.5 months of inventory countywide. That shift alone has rewritten how homes move. Prices aren't free-falling, but they're leveling out, and sellers are having to work harder for each offer. In the luxury pockets of Heath and some of McLendon-Chisholm, we have deep buyers markets with 9 months of inventory or more, a complete 180 to the frenzy we saw not too long ago. The story here is clear. More choices for buyers, less leverage for sellers, and a return to what economists like to call price discovery. Translation, buyers get to negotiate again. This isn't just a Rockwall story, it's a DFW story. Inventory has risen everywhere as builders finish projects and more homeowners finally decide to list. Rates are hovering around that low to mid 6% range, which keeps some buyers stuck on the sidelines. So we have strong long-term demand from relocations and job growth, but short-term affordability is holding things back. It's what analysts call a stuck market. Not broken, not booming, just waiting for financial conditions to catch up with pent-up demand. Let's hit the highlights. I'll keep it short and send you to livinginrockwall.com/stats for the charts and the data. For Rockwall, the city, think of it as the county's steady heartbeat. Inventory has grown, but prices are holding up better than most. Homes still move when they're priced right and show well. Heath. This luxury market is under pressure. Prices have come off their 2025 highs, and buyers have their pick of the litter. Unique homes with standout features still shine, but competition is pretty fierce. Fate. This is new construction central. Inventory is high, but so is demand thanks to builders offering incentives, and buyers are chasing affordability. It's our most balanced market right now. McLendon-Chisholm. Well, this is volatile and thinly traded. With fewer sales and more listings, the leverage leads heavily to buyers right now. Patience and pricing discipline are key here. Rockwall County is adjusting to a new normal, a market where the playing field is finally leveling out. Buyers have time to breathe, and sellers have to work harder to stand out. So where is all of this headed? The short answer, we're in a period of adjustment. Not collapse, not chaos, just that the market is finding its balance again. Over the next 6 to 12 months, I think Rockwall County's housing market will keep moving through this stabilization phase. We'll keep seeing plenty of homes on the market, especially in the luxury segments like Heath and some of McLendon-Chisholm. Even though listings may dip a little over the winter, there's enough supply out there to keep things feeling balanced to buyer favorable well into next year. Prices are still searching for their floor. In Heath and McLendon-Chisholm, more price softening is likely as the market keeps recalibrating. And really, we won't know where that floor is until prices start trending back up for several months in a row. Meanwhile, Rockwall and Fate are showing more resilience, but expect to see seller concessions, builder incentives, and sweeteners to keep deals moving. And sales will probably stay quiet, similar to what we've seen these last 2 years. Even if mortgage rates tick down a bit more, the higher inventory means we're not snapping back to those lightning-fast pandemic years anytime soon. There's still a lot to be absorbed. This is a deliberate, steady-paced market, not a sprint. So to sum it up, this is a smarter, slower, more strategic market. If you know how to read the data and how to act on it, you can still win big in 2026 and beyond. And if you want more details into what's happening with your specific home, head to livinginrockwall.com/stats and click on the Home Hub button to see your current home value. And if we haven't met yet, I'm Jennifer Templeton. I'm a broker associate with the Crestedge Group at Keller Williams Rockwall. Our group specializes in bringing next-level marketing and expert guidance to every home we sell. Because in today's market, visibility and strategy matter more than ever. Whether you're buying, selling, or just planning your next move, start with some insight. You can reach out by phone or text at 214-803-4444 or send me an email to jennifer@thecrestedgegroup.com. I've also added a link to schedule a Zoom meeting in the description below. Thanks for watching this video, and I'll see you in the next one. Bye.